because in crypto, it's a lot about like relative valuation. So like the top apps are a certain percentage of like the L1 they sit on, for example. And if you're looking at the public markets, I think you're not only looking at whether or not something is like a good business in a way or has like positive traction, but also about kind of a re-rating of that dynamic and re-rating of their position relative to other things in the market. So I think like the flexibility as an investor to do different stuff is important. And where you get into trouble a lot is if you are committed to one thing and then the market kind of changes on you and you don't even have the ability or have thought about doing that other thing.
And we're live. Welcome back, everyone, to another amazing podcast session. I think we've been relatively good on schedules recently, which is good.
I think it's been like a month almost, man.
Oh, maybe. I'm so relatively good. We haven't had like a multi-month break, which we did a couple times. But anyway, we have a special podcast today. Mika Honkasalo is joining us. He's on that side of my screen, which is why I'm pointing that way. He's the partner at Equilibrium Ventures and general like crypto OG person. And he just informed us off camera that he's got a lot of rants lined up, so that fits with our general approach to podcasting. So yeah, nice to have you here, Mika.
Thank you. I'll try not to get too angry or to take it too far. Maybe I should say here that anything I say is not financial advice. Yada yada. Kind of get the investor VC caveat there. So if I say something, don't go immediately to sell or buy. Or if you do, I'm not responsible for that. So maybe that's a reasonable thing to start with.
I wouldn't be concerned about getting too angry. We have Ricardo here, who is well known for getting very angry at all kinds of things. But cool.
If nothing else, they must have calibrated what very ranty means when it comes to a podcast. So I think you're fine.
Okay, that's good to know.
Yeah, we aim to be maximally uninformative while being maximally animated. Anyway, we thought we would discuss maybe sort of like the investment landscape in general a little bit. I have a lot of thoughts on this, especially I guess we can touch on kind of like the private markets and the public markets. But do you want to kind of lay the groundwork, Mika, for what you're seeing, and then we could dive in from there?
Yeah, I mean, the kind of, if you think about the past 5 years maybe, or post the ICO bubble, the kind of biggest arbitrage in a way in the industry has been between the public and the private markets. And for a while there, it was really an arbitrage in the sense that it was kind of no loss from the VC side in a way, as long as you were doing at least a reasonable job and you were the beneficiary of kind of those outsized outcomes in a way that the public markets weren't on average, or it was at least much more difficult to get to. And I think that dynamic kind of changing over time is maybe the number one thing in the investment landscape. So now you kind of have got into a situation where the public markets are starting to punish, I think, the private markets a lot more than they have previously. And certain kinds of deals. And there's also like a lot of dynamics in just how the VC market plays out in terms of what kind of structures people invest in, how they invest out of those, like what they're able to do, what they're not able to do, what's like in the mandate, what do investors want, who the investor base is. Because like right now it's kind of very crypto based, but in 2021 it was people coming outside of the industry with money to invest in, so they have like a different landscape. So a lot of those things kind of play into what the situation is now. But I think right now where we have gotten to is much more that the arbitrage in a sense doesn't exist that much anymore, and especially kind of at the later stage, the market is much harsher on projects where, because when you raise large funds in crypto, then the thing you kind of have to do is invest in later stage, and later stage in traditional VC tends to be about growth and product market fit once you have growth. And in crypto, that's kind of still an out there concept in a way. So you can get in trouble betting on companies that are kind of like blue chip names, but they don't actually have product market fit. And like recently, I think you've seen when those come out with tokens, the token price action is like pretty poor, and the investors aren't getting a free lunch anymore. So I think that's maybe a place to start here.
Yeah, so I actually just had a conversation with a colleague about this, and I think there's like, so what you're describing is certainly, I think, the sentiment. Like, I think it's very tangible in VC circles. Like, people, I would say, are describing it as a depression, not like a recession, just like a, emotional depression. And I have to say that I think it's like yes, public markets are punishing like insane valuations, which is probably good. But on the other hand, and I think there's kind of two perspectives. There's like what is actually happening now, and then like how does that compare to past cycles? And what is actually happening now is like, okay, you have like launches at like double-digit billion valuations, and they're getting punished. And then they go down to like 4 or 5 billion, like Celestia, Starknet being good examples. But that's still like a very good outcome, right? Like, okay, Starknet raised around, I think the actual valuation ended up being something like 7 billion. And so from that for that last round, yes, not ideal. But if you think about past cycles, and how many like multi-billion dollar FDV launches there were in general, we have more than 10 in the last 6 months, and they are holding at upwards of $1 billion. All there's so many of them now. I was just scrolling through CoinMarketCap. If you look at like all the projects that have an above 1 billion FDV valuation, you need to go past like the first 100 to find projects that are not at that, which is kind of insane. Like, so this may be true, and what did happen sort of between maybe the last bull market and this bull market, or maybe it started maybe even a little bit earlier, was that the VC valuations started going up like crazy because the expected outcome was so high, and that's maybe like tapering off a little bit, where VCs are now starting to realize, okay, like they shouldn't do like a multi-billion FDV private round because like it's not a guarantee that it's 20 billion. But it was never a guarantee. Like at no point in crypto's history was it like was it like just obvious that everything would be 10 billion plus. Like, we've only started getting smaller projects at those kinds of valuations like post 2021 maybe, or something like that. And so I think it's fairly reasonable, and I think it's still very investable. So like what you probably end up getting is like, okay, like your A and your B round won't be valued at $1 billion, but like it can still be valued at 300 million or whatever. And so it's not like crazy. So what I'm getting at is I think the depression is somewhat strange, because certainly like there remains huge upside, and not only is there huge upside, it seems to be like reachable for a much larger amount of projects than it did in the past. But I'm curious what you think, Ricardo.
I was actually thinking this doesn't necessarily match what I would think about the markets when somebody says the public markets publishing the private ones, I wouldn't necessarily call this punishment. I mean, we got in the past cycles large funds that got cocky and invested on things at stupid valuations that didn't really necessarily materialize. I mean, like, first one that comes to think is the sandbox, for instance. So we have gotten this before. This is basically just people getting a little bit greedy. And again, I don't think necessarily is an issue of taking those valuations for granted. I really don't know the mentality of somebody that we have discussed before that values something like Sui or Aptos at the prices that they were being valued, right, other than the benchmark. So from that side of things, it just doesn't really scan to me as anything different from before. Maybe just the scale of the things that we're getting now, right? Like at the very least, the scale of the valuations at later rounds. So not entirely sure. I mean, personally, can't think of an example where I would say, oh yeah, that was a stupid bet and those people got seriously burned, which is what I would qualify as being punished. Has there been any case like that where the actual public valuation landed well below the last round of a rather high project? I can't immediately think of one.
Starknet,
well
I
below?
don't know.
I thought it was
right
in
now
the neighborhood.
It's trading at like close to half.
Yeah,
Okay.
it depends a little bit on what you mean by punishment, but at least there's like a closing of the kind of obvious arbitrage in a way, where the last rounds tend to be like quite high, so that the public market can't give you at least venture-like returns anymore. Maybe one thing to consider there is also like kind of timing on all this stuff, because the VC market tends to lag a little bit behind the public markets. So if the industry grows in general, you tend to get like kind of bailed out in a way of your positions where the public markets are like higher. But I think where you run the risk is that if you are in a place where you invest in like kind of later rounds and then the public market valuation is kind of close to you, then you start to at least be in a place where you can take a hit pretty hard if the market kind of goes down. And I think in 2021, you did kind of see actually examples of those kinds of growth rounds. You probably haven't here because like the market has been good enough to kind of bail you out in a way, but it still puts you kind of in the ballpark of taking a lot of risk. But that's different, of course, from like early stage venture, which is also, and like lower valuations, which is our focus as well. I think that's still kind of historically has been the best area to be in, which is you want to be the first one to an idea, to a new concept, and kind of bet when others aren't looking at something like that. And I think that's still a market where only like VCs or nowadays kind of angels can participate in a way where that's not available to the public market. So that's still, I think, quite relatively high arbitrage, or arbitrage is maybe the wrong part, but relatively like large return potentials. But yeah,
So
like
if what you're saying is that late round investors don't have like a free money basically anymore, then that I definitely agree with. That's getting compressed a little bit.
Yeah, it's the Tiger Global type strategy is like, I mean, it didn't work for them either, but that it's like it's sort of more obviously not a viable strategy, because like you're basically coin flipping. Are you going to be down 50% or are you going to be up 50%? So that's interesting. What I mean, what we've talked with you, Mika, quite a lot about is also that there are like not like a huge amount, but there are like projects that are public that are trading fairly low compared to private market valuations, who like have some semblance of product market fit and so on. And so that I think is interesting. So like what I'm talking about is we do seem to have this trend where like a new project launching always launches very high and public markets like do actually value them fairly high. Like even if Celestia traded at 20 billion at some point, it's now 5. That's still high. But then you have projects that are trading in like the 100 to 300 million range, that are maybe a bit older, that like don't like the enthusiasm for valuations doesn't translate to like all parts of the market. It's very sort of like new thing driven. And so what do you guys think about just in general, like the trade-off of like doing private market versus public market? Because it does feel like there's potentially a decent amount of public things that have as much upside as private market things, or more.
In the kind of Gartner hype cycle thinking, there are like public market assets that have been there for a while, that have kind of gone through the hype cycle and then like the disillusionment, and are kind of like actually in many cases kind of generating revenue. They're on a kind of a positive path in a way quite often, and then you kind of have to evaluate whether or not those are really able to take off in a way that they haven't before. Because in crypto, it's a lot about like relative valuation. So like the top apps are a certain percentage of like the L1 they sit on, for example. And if you're looking at the public markets, I think you're not only looking at whether or not something is like a good business in a way, or has like positive traction, but also about kind of a re-rating of that dynamic and re-rating of their position relative to other things in the market. And I think there's kind of, as an investor, you should be able to do multiple things and kind of cover multiple different scenarios that may happen. And there probably is like an underinvestment, I think, into those scenarios in a way compared to like the new thing. So by definition, I think that means also that there is like untapped upside there. And if you are kind of investing in something liquid, you probably are the first to the trade in a way that you may not be on the private markets, because there's more activity there, and you kind of want to be the first to a trade or an investment in as a part of your portfolio in a way, because it gives you a kind of different risk profile than what you have in other parts of your portfolio. So I think like the flexibility as an investor to do different stuff is important. And where you get into trouble a lot is if you are committed to one thing and then the market kind of changes on you and you don't even have the ability or have thought about doing that other thing. I think we've seen that example quite a bit kind of so far, especially with traditional investors coming into the space and having to make equity trades, for example, and there not being that many good ones out there. So if you're not able to always be flexible in kind of what you invest in, you do lose out in any case, I think.
Yeah, I agree. I come at it from a slightly different perspective, I guess. I mean, Teemu and I have had a few exchanges both on and off camera about where I put investment versus trading in general. And I guess that for me, there's a significant difference on approach between both. I mean, if I'm going to, and again, Teemu and I have gone over quite a few opportunities off camera. And what I've found, the main difference between these two is that when I'm looking at something as an investment, right? You're coming in early, you're likely going to be locked for a while. I tend to come at it a lot more with a much harder diligence approach, I suppose, a much more stricter diligence approach, and a significantly more thesis focus, in chance I'm going to be married to a thing for a few years. Whereas when it's something liquid, I tend to be significantly more flexible, right? You tend to look at what else is out there. You tend to change your approach as you go. If things really stop moving in a certain direction or you get new information, you can just bail out of it or reload. So yeah, there's definitely a different balance. I think that I have gotten In fact, if I would need to look up the numbers actually, but I think that adding up, I would think that most of the value that I've gotten has come actually from the public liquid trades, not from private things. But that might just be me being extremely picky with the things that I end with it. Basically, the things that match my area of interest, the things that match my area of interest that I have access to, and that pass my diligence process tends to be like a really small set of things. So.
Your Venn diagram has like a non-existent middle zone.
Exactly, it's a tiny middle zone, and even with some things that we've discussed that I was rather interested on, then we found like, oh yeah, there's this particular factor here that could blow up down the road, and that particular thing just ends up killing the whole interest for me. Anyway,
the outsized outcomes still always come from kind of the investment mindset, whether or not you're doing liquid or private, in the sense that there are always there's always things happening. There's always like the next 10x. There's the next like fundamental bets that others aren't seeing that you are. So even like when I say trade, I just mean like the positioning of kind of, are you on the right side of in a way the attention and the thinking on whether or not something will be big, and like that positioning and being kind of the first to a certain theme. That's kind of what wins you, and then the overall kind of market growing, and that being a lot of beta to that, and that's where you kind of see outsized outcomes. Because in crypto so far, since it's been so cyclical, timing has been a big part of returns, and that's why you kind of want to be on the that's why I say trade in a way, because you do need that timing component also to work for you, to generate returns.
Well, let me give you a specific example, and I'm not going to name the project, even though it's likely easy to narrow down because we brought it up a few times. We're looking at this particular platform that I was interested in investing before it went public, and everything looks good. Numbers look great. I'm interested. I like the approach of how they're going about things, but then the team is partially Russian, and I find an ad in Russian of where they're hiring for developers. I asked a Russian friend if he could translate this to see what it means, if they're just hiring Russian speakers or they're hiring people in Russia. And and he tells that, they're willing to hire globally, but mostly in Russia, right? And then this raises a potential concern, right? Because I'm going to be investing on something that is locked. Now, suppose that one of these developers, for whatever reason, gives them an address to pay that ends up on a sanction list, and this ends up being traced back to the team. Is this going to be a problem for the team that is going to impact things significantly while I am locked for a couple of years, right? If this were something that if this were an investment that I'm making on something that's public and liquid, then I don't care about that much, right? Because if that happens, I get dumped immediately. On something that is locked, that becomes a much larger concern. And it would be something that's not necessarily even the team screwing up, right? It could just happen by the person not even knowing that they shouldn't be using this particular exchange, right? The person that they're hiring. So even concerns like those come up when I have to consider that they may do something, not even careless, something unlucky in the next 3 years.
Yeah, maybe one way to think about that is kind of how the market prices illiquidity. And I think like if you take any project that's trading in the some 100 million range, that's pretty good, and has some product market fit and like a good roadmap, and is generally going in the right direction. Like the illiquidity premium is something like 50% for a year in a way, and that's kind of the market pricing that. So if you take that back to kind of the venture market in itself, where seed rounds are raising at 20 to 30 million, and you take that like liquidity, like kind of profile in a way, that means that it's implying like 60 or 80 million valuation at the current moment, and that's where the arbitrage is actually kind of like closed in a way. The market is relatively like efficient in that way, where it doesn't allow you to get, because you're tying up capital for 2 or 3 years, it doesn't actually allow you to get a free lunch, because the way the market prices illiquidity anyhow is like in like the kind of 2x 3x range.
Well, yeah, I mean, I think the market pricing of liquidity is kind of skewed by the fact that the VCs do need to deploy. And so like they will like I don't think they're regimented in that line of thinking, simply because like they actually do need to make investments, and oftentimes they're constrained, like they couldn't even do liquid markets if they wanted to, etc. So then like even if you think so like even as a VC, if you think that something will like not launch at the right valuation, but may get there over years afterwards, it may make sense to put in a bigger ticket and sort of like not arbitrage it simply to get money out the door, which is like a funny incentive in a way, but like it is kind of real. And I mean, this is visible in any VC portfolio. Like there's going to be a handful of projects they've invested in where you're like, what the fuck? Like why? But to bring this back to kind of market sentiment, so I want to just quickly kind of get your guys' take on like are we in a bull market now, or are we pre-bull market, or are we moving towards post-bull market? And specifically, like if you look at sort of Bitcoin or Ethereum, like they're trading sort of near all-time highs, but almost nothing else is. So if you look at like XRP, Polkadot, Stellar, like any of these assets that historically have reacted to bull markets, simply because there's so much money coming in, it kind of just, rising tide lifts all boats kind of thing. They have basically not reacted. Like they're flat. And there's a lot of stuff. So I mean, this is a common thing that people have been saying. Like there's like alts are not doing that well. But I wonder if like that is somehow indicative of what's happening. You can argue that they just suck and like whatever. My counter to them sucking is like sucking has never prevented all kinds of chumps from investing in them. And like if you look at the graphs, like every cycle, bang, right? And now flat, that feels like this is not a bull market. If the only assets reacting are the ones that have ETFs, then like maybe this isn't bull market behavior at all. But curious to get your take.
I mean, have you looked at the Solana, at the Sol BTC or Sol ETH chart? Sure, it's not at all-time high. All-time high is the Sol, the asset itself versus the dollar.
Is fine.
Sure,
Solana is
which
fine because it's in that kind of like, I don't know, it's in the ETF bucket.
No, it's like people started putting in the ETF bucket like a week and a half ago. That argument doesn't track. I mean, look at Arweave. Arweave went down to like $5 and then it bounced back to 30 something. And Arweave is not on the ETF bucket. It's something that the majority of crypto people, chances are, have never heard of. I do think that there has been quite a bounce on quite a few things, and it hasn't been across the entire market like it happened before. Like, flow is still sub $1 or whatever it is. But Stellar.
But so my point here is that like a flight to quality as a concept is not actually bull market behavior.
There's a couple of
this could be wrong, but like I'm just saying, like bull markets are pretty indiscriminate about,
No, this is not necessarily. I'm not saying this is a flight to quality. Remember that we had this discussion a while back where basically I mentioned that I thought we were going to see a little bit of a polarization. And I suspect that what's going on is that the dumb money that would have flown before to Stellar and Ripple and whatnot has actually flown to meme coins, not to, middle of the range projects without much traction, because those had gotten quite a bit of volume. Most of them burst, right? But clearly there has been influx to those as well.
There's a couple of different ways to answer this. The kind of, if you just quantitatively look at it, like BTC dominance has like very, very steadily gone from 30% to 60% over the past 2 years. So that means that kind of BTC is doing well relative to the rest of the market. And there has been a very large dispersion on what outperforms it and what doesn't. And that is not, that's actually like early bull market behavior in a way that happened also last time, which is that you had like the steady climb of BTC dominance until the kind of everything went up, and the everything went up kind of effect comes from a lot of new participants in the market who are not discriminating either based on the rules of kind of how people in the industry are. They just have their own way of what assets they buy, their own kind of selection criteria for that. And right now, the market hasn't gotten to a place where that's happening. So even like right now, if you look at the metrics around Coinbase's app ranking, search volumes, yada yada, all these kind of retail type of indicators, or you just look at like Coinbase's quarterly report and look at the retail volumes there compared to institutionals. The retail volume is not there, so you don't have like this non-discriminatory asset buying from a new cohort. And I guess like what defines like a proper bull market in crypto has been new money flowing in. And it is interesting that mostly, well, there is like new institutional money flowing into the ETFs, but mostly it still has been just within the crypto industry. And it hasn't, like, the scars of 2021 in a way haven't healed, and we haven't found a new financial primitive, a new way to kind of really kick off something very odd and like more parabolic in a way. And it's not
always new financial primitives.
It is.
Like
it's an ICOs the first time, the second time, or ICOs not the first time, but like the 2017 one, ICOs. The second one was started by DeFi liquidity mining in 2020. So it's actually a financial incentive that kind of kicks it off properly. Like you could bring back the ICO today and it could do that actually. Like there's an argument for that okay, if you are able to, that's why the meme coin thing is kind of like ICOs, because you're able to participate early, get like venture-like returns on the public markets. So actually, if you did that kind of again, that might be enough to like kickstart something like a much crazier than what's happening right now.
The problem with ICOs, so like if you look at like CoinList sales or anything like that, they're not performing very well. Like the largest CoinList sort of token sale, I think this year has been like 24 million. And I mean, that's a lot, to be clear. Like it's, but that's not euphoria like amounts or anywhere near. I mean, this there is, so one thing that we've been hearing from a lot of the exchanges is that basically exchange organic volumes are like non-existent right now. Again, not bull market behavior at all. What the exchanges seem to think is that public markets do not see enough, like retail doesn't see enough upside. And so coming back to the ICO point, I'm actually very much in favor of ICOs. Conceptually, the problem with ICOs is that all kinds of idiots raise huge amounts of money and then don't do anything. Like if the only thing you need is to say that you're going to build a metaverse, then you get 100 million. Like there's a lot of people that are going to take that deal. And so there needs to be some kind of balance, but like I think what I was getting to was like, yes, ICOs or something like that could bring it back. And in fact, ICOs are quite easy in Europe now after Mika. Like, I think Europe might be like the holy grail of new ICOs. Depends a little bit on your categorization in terms of like, are you a utility token? But for utility tokens, Europe is super easy. Like, you can issue from whatever country, any company, any foundation, doesn't matter. All you need to do is put out a white paper that meets the regulatory requirements, but that white paper doesn't need acceptance from any kind of financial authority. You don't need any licenses. Europe is good. If you're in the other asset classes, there are other regulations that apply, especially if it's like financial services equivalent things. But so the exchanges are currently kind of pushing projects to essentially do token sales at lower valuations, to try to get this like retail interest going again. And this has to do with listings as well. So like, if every token lists at 20 billion Celestia, then they get no trade volume and it just deteriorates from there. And that's like, the exchange doesn't like that. They would like it to go up and increase in volume, etc. And people making returns drives more users to make come in and so on. But I think it's quite hard to kickstart. So like who like, you need so many projects kind of to like do it before it looks to be working and kind of get non-optimal outcomes before it sort of starts working, right? Like, if retail's not there, then doing an ICO to retail is like not a very compelling proposition. And so I'm not sure how that kind of plays out.
Rather than these dynamics, I just want to have like apps and use cases that hit product market fit, and then like the kind of get a more classical style of, like, we have very financialized bubbles so far in crypto, but get more of a classical one, which is like a usage driven one, where then the expectation of that usage is too high. Like, you'd much rather be in that situation. I mean, we can talk still in this podcast about some of those ideas, but like, the success Polymarket, for example, has had, you'd like to see like 25 different apps basically have something like that, and then you would have a much more kind of solid base, I think, to build from, than kind of hoping for the dynamics of the market to be perfect in a way.
Well, do you think that Polymarket has had success because it generally has product market fit, or just because it has product market fit at this very specific point in time where there's a particular event that has so captured people's obsessions, like it's the US election?
Well, the answer is mostly the second, but I think that's already quite impressive, and like worthwhile, and something good for the industry. If you look at Polymarket, actually only 70% of the volume, I'm saying only, quote unquote, is the election markets and related to that. So it's actually like there is some other volume, and they have, TradFi just did like a pretty good post on this, where they have pretty good retention for users as well outside of like election markets. So like, there will be this scenario after November where the volumes go down and people will kind of have a disillusionment around it, but they are in a position where, okay, like these event-driven ones drive a lot of attention, eyeballs, give you distribution, and then you have to just be able to provide other markets that are like kind of in the same, or like kind of continuing on, so that you're able to drive volume, and so like even if they take a dip, that's fine.
Yeah. Let me just touch on that quickly, because I think there's like a couple dynamics that are interesting to debate. So like there's been a lot of prediction markets in Web 2, right? And they've generally been super election driven, and then they kind of like go down from there. Like, I think it was the founder of FanDuel had a good post on this on Twitter. So like, FanDuel used to be a prediction market, and then they pivoted into FanDuel because that was like a much bigger revenue opportunity. I broadly think, historically speaking, prediction markets have sort of been a very US election driven type thing. However, the counter argument to that, I think, is that our world has an increasing amount of uncertainty, or like at least perceived uncertainty, around like the legitimacy of content, the legitimacy, like all our news is piped to us by various propaganda operations. Is I don't know if you guys have had this experience, but I feel like the world right now is for the first time like experiencing what it is like to be aware of every person dying everywhere. Like it needed a couple wars at the same time, and a couple protests here and there, and now like our very limited attention is basically being like attacked. I want to use like an even more crude word, but by a never-ending barrage of like negativity from all directions. And it's very hard to piece together like anything resembling truth or reality from that, because like essentially your emotions are getting targeted. Like I was just talking about with my wife about this, like you can't use any service. Like you can't be on YouTube, you can't be on Twitter, you can't be on Instagram, you can't be on TikTok. Like if you want to avoid that, like you need to like go all Unabomber and move into the woods and like hunt for your food and shit. Is that what you're doing, Ricardo? you put up your hand.
Not entirely, not yet, but working on it.
How deep into the Unabomber journey are you?
Well, we are recording this on Google Meet, so obviously not that far.
Yeah, but I think that's an argument for prediction markets potentially having a more consistent usage.
I don't necessarily agree.
They're used as a data point. So the other way to think about it is like, I'll stop after this, but the like community notes on Twitter have been fairly successful. You could imagine that essentially like prediction markets are used in a similar way across a large amount of different kinds of messaging. Like you could have a prediction market try to like just get to the bottom of like, is some specific narrative like crafted, or is it actually happening, and so on. Like there might be applications like that are increasing.
I hear you. I think that it's possible, but not nearly as widespread as one would like to deal with the general uncertainty of the world. Basically, what I think is that prediction markets are not likely to help you converge on fact effectively, because you need facts to be able to adjudicate them, external facts. So just to give you an example, suppose that you were going to start a prediction market right now on what is going to happen after the November election, regardless of who wins, right? You couldn't make a prediction market, or in Venezuela, for instance, you couldn't make a prediction market on is the Venezuela election going to be legitimate? You could just make a prediction market on, is the Venezuela election going to be declared legitimate by the United Nations, or is it going to be declared legitimate by these three countries? That doesn't necessarily mean that the election was legitimate or not. Like a lot of Trump supporters still argue that the last election was legitimate. It just happened to be called for Biden, right? So I think that on most of the issues where people are getting this cognitive assault on misinformation, the prediction markets are not going to be able to adjudicate in any way that solves the mental issue that this causes.
I don't think it necessarily has to solve. Yeah, I don't think it necessarily has to even solve anything. It just has to be popular, right? It has to be entertaining. It has to be something that the market will want to use in various ways. And there, I think I agree with them. There was like a post by Casamani from Multicoin, which was, okay, prediction markets, you're able to generate volume on the election, but what you want after that is to do basically sports betting, because that's where a lot of existing volume is. And that's incorrect if the category is just new, where, okay, like everything in the world that is newsworthy, and there's all the time lots of stuff, starts to trade, like the election, and what the market precisely is and whether or not it correlates with like an outcome that is beneficial to society is not necessarily what you even care about in the case of like the success of prediction markets. You just care if there's volume or not and if people are interested in it. And it is a new way to interact with news and consume news as well. And you can easily imagine, I think, the poly market like numbers or something like that being a part of news stories, being a part of, you know, tweets and things you see all around. And that's all it requires to be successful. It doesn't actually require it to like do a good outcome in the world in a way.
That I agree with. Where I'm drawing the line is by saying that this is unlikely to become a tool like community notes per se, just because in a lot of those things.
Not a truth machine.
Exactly, but I definitely agree. There's a lot of possibilities for things that can bring value to this, or where this can apply, because there are a lot of events out there that are unequivocally you can unequivocally adjudicate in one way or another. So,
but like, maybe it wasn't the best example, but like I do think prediction markets potentially are like, I mean, truth is, you know, what is truth? Blah blah blah, probabilities. But I do think they can be truth machines to a degree. Like what we're seeing across a large amount of countries is basically intentional misleading of the populace to think one way or another about like what's going on, right? And when polling is one area where this is happening, for example. And I do think prediction markets potentially expose, for example, like rigged polling results, and so there are elements where it like overlaps, or they can expose rigged polling results. So wherever there is a huge discrepancy between sort of some institutional, you know, probability of success that's being put out and the prediction market, it raises questions as to what's going on. Maybe doesn't answer them, but raises them.
At a large enough volume, I agree.
Yeah, but I mean, I think the argument that this has happened before and this has happened in Web 2 does exist. I suspect there is a non-trivial sort of barrier to entry in any Web 2 way of doing this. Not barrier, but just sort of like it's not as easily accessible by everyone in the world, which could indicate that this play market could be more successful than the previous ones. But at the same time, the prediction markets thrive on like a never-ending, really big deal going on. And right now, like, and this is kind of my original point, it feels like there's a lot of really big deals going on. And so maybe they'll do better, but if those go away, then yes, it kind of, I think, deteriorates back to irrelevance. But since we're on the prediction market thread, we can maybe touch a little bit on Futarchy, given that there was a couple things happened, and this is sort of like me and Mika were looking at a project called MetaDAO, which is basically Futarchy for projects on Solana, and then last week there was the compound governance attack in air quotes, and so I think this is a pretty timely thing. So just for people who are not familiar with Futarchy, it was a thing that this guy Robin Hansen came up with a long time ago. It's been talked about in the crypto industry for going on 10 years. It's one of those like nothing is ever new in crypto type things. And the general idea is that instead of having like voting for governance, you bet on the outcome. So it's a prediction market for the outcome, and you specifically bet on whether passing some proposal will lead to like a positive or a negative impact on the market price of the token, and on some time frame. And so one interesting thing to maybe dive into a little bit is like, would Futarchy have prevented this governance problem that Compound had? It was called an attack because there had been no engagement with the community, and it passed, and it was basically like it was, what was it called? It was called like Comp Gold or something like that, and they were like, okay, give us 500,000 Compound tokens from the DAO treasury. And like there was no one knew if it was even real, but it passed. So someone had enough Compound tokens to pass that proposal, and people thought it was an attack in the sense that like they thought that essentially someone had acquired enough to pass it. And this of course is potentially an issue, because like if you can momentarily accumulate enough votes, you can essentially pass anything. And so like the much more extreme scenario would be that you empty a treasury by simply getting enough tokens. And so my question to you guys is, do you think Futarchy would have prevented this?
Well, I don't know necessarily if it would have prevented it. You can't say that for sure, but in MetaDAO's history, you have a good example of someone trying to mint and get essentially from like treasury meta tokens to themselves, and there being like a pretty high volume game of hundreds of thousands worth, and like kind of the market going against that. So I think that's a data point for Futarchy being better. I don't think it at least is worse. Just having been like from my own experience at Uniswap and MakerDAO governance, like token voting is very odd right now, and the practical implementation of something that you think is kind of straightforward isn't really that straightforward in real world. The number one problem is just people don't really show up, and number two is that everyone kind of has weird incentives and pressures among the people who have tokens delegated to them or have a lot of tokens to kind of do sketchy stuff in a way. So like that the status quo is quite bad for DAOs, and that's why I think like Futarchy is not at least going to be worse. And it also allows Futarchy to get like a pretty strong mode or strong positioning in the market, in a sense where like the Solana projects probably are going to use this thing, and to a degree that's not less successful than what they had before. And then you can kind of iterate on this model, start driving volume through it, start having attention on it, and then you can see like what the markets can actually do. But yeah, it's kind of like just if you're being simple about it, it's just an extension of markets, and you hope that the power of like free markets in a way leads to good decision making, and then you can tweak the parameters in many ways in the future, like how long term you want these markets to be, how many decisions, what kind of decisions, yada yada. But yeah, so I think it's very cool, and it's like one of these ideas that has been in crypto for a while, and for some reason no one has done properly, and this is the first proper attempt really at it.
I think like the interesting thing about Futarchy is like people are essentially betting on whether large holders will leave the token ecosystem due to some specific event. And I think, and generally speaking, like it allows people outside of that ecosystem to bet on that. That carries some risk to some degree, right? Like sort of non-token holders can bet on an outcome, but it also means that you're not reliant on your token holders to show up. You're reliant on somebody to show up who thinks they know. And I think that's kind of a better proposition, because it is aligned with the large token holders in many ways. Like some people who are tracking these things and who have a view on these things will show up and put money down because they think you would be mad if this went through without you having ever seen it, kind of.
I'll say this has happened in like notable DAOs. Can't really name who, but like where governance has gotten pretty ugly. There's like these dynamics with lending markets and like borrowed tokens as well that go into governance, and then that has led to like large holders just selling. I think a good example of recently where you could imagine that happening is Arbitrum approving like 250 mil gaming fund, which to any reasonable person is not reasonable resource allocation. And that probably is a net negative to the thing, I think by quite a large margin. And yeah, those are the types of decisions that you want to be able to correct. And I think in this market mechanism, you actually probably would have been able to do that.
What does
I
our
dropped there
local
for a
governance
bit.
expert think?
I think Mika is more of a governance expert. I'm just a governance old man yells at cloud. I dropped there for I don't know, like a minute or something, so I may end up repeating something you guys already said.
Right.
Just an objection to what you said, Teemu, that you described that this is kind of like a bet on if the token price is going to increase or not. That's at the very least for MetaDAO, that's not exactly how it's implemented. The proposal is resolved based on effectively trading. So it is the result of whomever side versus proposal passing or proposal fails end up doing financially better. That is what resolves the proposal right there. And yes, you yourself might be making a bet that the token is going to appreciate or depreciate as a result of this, but is not that final token price at some point in the future that actually ends up resolving the decision. The other thing, which I actually think Futarchy is interesting, is that you mentioned that this allows non-token holders to participate in governance. It does, but that's actually not a bad thing because for two things. The first is for non-token holders to participate in governance, they actually need to then come in and put USDC collateral up front, right, for this trading process. They need to be trading in a cognizant way where they actually want to actually have a good financial outcome for themselves, or than just setting whatever amount of dollars on fire. And the third thing is that if the side that they end up actually voting for, that they end up trading their dollars for, ends up passing, then they will end up getting the conditional, well, the tokens equivalent to the conditional tokens that they end up voting with. So they do become token holders at the end, assuming that they didn't trade everything away, which is unlikely without tanking their own market. So I don't think that's a problem in any way. It's actually a good way to bring new entrants into any.
It's worth noting that's like a liquidity thing, because like if the token is liquid, you get to make just the difference on that trade. So it's not like you're actually quote unquote forced to hold a token in a way, yeah. But you just receive that difference, and if the market is liquid enough to give you 100% of that difference, it is like a pure profit play based on the decision and not becoming a token holder.
Indeed, and there's also, I don't know, I mean, the main issue that I have with discussing Futarchy right now is the fact that we don't have that many examples of actual volume, and it's in actual volume that things end up coming out that you didn't expect. I think MetaDAO is the only one, because Drift has used it, and it's at an average of like $7,000 per proposal, which is nothing. But it is definitely an interesting system. I mean, something that I really like about it, well, there's two factors. One of them that you already brought out is the fact that you actually need to put something at risk, right? It's not just I have this big bag of tokens and I'm going to vote for this sort of thing because whatever, right?
I'm going to vote for this other thing because it transfers tokens from the treasury to me.
or to an organization that I care about, like with the Uniswap DeFi education fund that transferred a whole bunch of tokens to an organization that ended up not even holding for as long as they say they were gonna. But so anyway, there is an impact on you making the wrong decision here, or at the very least on proposing something that is unpopular. You may end up having a financial hit. But something that I really like about this actually is that there is a, we keep going on about how there's a plutocracy problem in crypto, but it's not just a plutocracy problem. I think one issue is that participation becomes more expensive. Participation in any decision becomes more expensive the later that you came into a project, right? And we were just discussing about the arbitrage opportunity between coming in and between coming in on an early private round or later. And the fact is that chances are, if you came in on an early round on any project, you're sitting on a massive bag of tokens. The chances are you cannot do anything with them other than vote. So why are you not just, because they're locked, so why are you not going to vote your own way, right? In the Futarchy approach, given that you couldn't just trade with the locked tokens, because these tokens need to be liquidatable at the end of the process, then you actually need to come in and put value at risk up front, and your value is as good as mine. Effectively, it's not that you have all these votes that you acquire for 1 cent, and I have the votes that I had to go out and acquire for $100, right? This I think is likely to end up making a massive difference in the quality of decisions, because at that point, if you're Andreessen Horowitz, yes, you have deeper pockets than anybody out there, but now you need to decide if you actually want to risk that extra value on forcing this particular decision through. So it's
well, and predicting how the community will react, right? Because like anyone else can also like, and so to just touch quickly on the volume thing, I think in Futarchy what you would expect is most markets to be relatively low volume unless they're contentious, and then they get very high volume. Same with prediction markets mostly, I would think. Like it, some of the proposals are like, should we add, a new color to our logo? Like you don't need hundreds of thousands backing those kinds of decisions.
But you could do
that.
that. Like
that's not a great example, but yeah.
But in reasoning about this, like it's quite difficult to reason about the volumes, because that market could get a lot of volume even though it's an insignificant decision, versus a significant decision may get little volume, but it just means that no one's like, there's no contest in a way, so you don't have like this effect of like going around in circles trying to like make your decision pass in a way. So like small decisions could have a huge volume and large decisions could have no volume. Is like in prediction markets, I think it's more about the entertainment value of the situation, versus here it's actually about the tension and the nature of the proposal itself, that what does it do, and that creates the kind of volume that happens.
Yeah. The other thing that I think is really interesting, and by the way, as a disclosure, Equilibrium Group holds a small amount of MetaDAO tokens. We've been excited about Futarchy for quite a long time. But the other thing that's interesting is that there is actually an inherent business model, which there is not in sort of like traditional governance structures. And this matters from the perspective. So like in the Ethereum landscape, basically everyone is running compound governance. And Compound made it. It's open source, so everyone just kind of takes that and plugs it into their own thing, etc. And that's fine. But there's not any single group who's incentivized to sort of improve that for everyone over time. And I think that's a non-trivial factor, is that like just having a business model within the governance system actually means you kind of the whole community is able to benefit from an allocation of resources to improving that consistently. And so in the MetaDAO case, it's basically just trading fees on the market. How big those end up being depends completely on like the volumes of these decisions, and how popular it gets. But at least there is one, and so that's a good thing. And then the other thing, and this is maybe a slightly more high level, I think from the traditional world and arguably also from the crypto world, it's clear that most people don't want to participate in governance. Like our whole society is set up in a way where like you have most people and then you have people who want to be in governance and they work for the government. um, and that's probably as it should be, like, well, I guess I'm sitting here with like two governance people, so maybe we're not a great sample of this, but like most people have no interest in being involved in local government, like your city or whatever. Like that's a very particular type of person. And it's very important that those people exist, but they're like a relatively small subset of the population. And what the traditional token vote governance means is like it's more like a democracy where everyone should be involved, except it's by topic, so it's very granular. And so it's quite a lot of overhead compared to democracy where you like vote once a year essentially. And so I think one big benefit of Futarchy is that it allows the creation of this sort of governance group of people, like a group of people, however large or small, that is only focused on governance, potentially across very many different protocols. And I think that is actually quite useful.
I don't think that's exclusive to Futarchy. I mean, delegation and liquid democracy already solved the issue of most people not having any interest, right? Like, I'm just going to delegate my votes to Mika. He knows what's going on. And however, for specific economic topics, I could delegate to Teemu, right? That's not let's say that delegation Futarchy are relatively
Sure.
orthogonal.
At the
I
end,
agree with that, but delegation has a much higher barrier to entry. So,
but
like,
at the
you
end
need
stage,
time
though,
to
I
delegate.
disagree. I mean, if you look at Futarchy, it's actually the mentality that you need to come at with this with if you want to make good decisions. It's actually close to market making, and people tend to be really bad at making trading and math decisions. So it's just a different type of barrier.
I'm saying you can have 10 USDC and participate in Futarchy. If you want to participate in token voting, you need to go to the A16Zs and whatnot and be like, "Hey, delegate tokens to me." That's a very different game. So
I meant the other way. If I don't, because the point is, if I don't want to participate, you mentioned that most people are not interested in participating in governance. If I'm not interested in participating in governance, that's fine. I can just delegate to you guys, right?
Yeah. At the end of the day, when you think about like token holder voting, all the incentives are like kind of correct in a way, where if you go through like the logic kind of list of okay, well, it influences your holdings, so you should be incentivized to make the right decisions, yada yada. That actually like doesn't necessarily change. I think in practice it just ends up not working as well as you'd hope. So the market, I think, is just a different way of creating engagement for those decisions. And that's
what I mean.
yeah.
It might be different people, right? So like
Yeah.
the holders are not necessarily the governors, the best governors, or even voluntary governors. And so like it's sort of like, yes, in theory this could all happen off chain, right? But it's sort of like a formalization of it that drives that behavior via incentives and allows people who want to govern to participate across a large number of different things. Of course, like the big holders like will be aware of what's going on there and blah blah blah, and they're sort of incentivized to participate at times as well. It just doesn't function on this delegate system. And the other thing that it forces you to do, which I think is really interesting, is decide on a dollar price you're willing to pay to not have something go through or to have something go through, which in token voting does not happen. So like in a token vote, if I have 40% of the supply, I'm not like deciding whether this is a fight I should take or not. I just vote every time and then I win, right? Like every token holder votes with their full voting power every single time, even if decisions in terms of their importance are not equal. And this is relating to the volume thing on Futarchy as well, which is that like there will be important decisions which I think will be very contentious, and there will be probably a lot more volume. But like on the other decisions, like you're not going to allocate $1 million to the logo decision. Like, you know, it doesn't matter. I mean, maybe it does. I don't, but you get my point. Like, there's actual value in forcing people to price the importance of that decision, even outside of how the market ends up resolving. Just like if it hasn't had any volume, like it's not that big of a deal, and no one needs to commit that amount of money. So it gives a lot more information, like a lot more granular information about the governance process in general. Okay, are we done with Futarchy? Feels like we're done.
Yeah, it seems like we're all shockingly in agreement.
Okay, we're
Boring.
full agreement. Should we touch on Arweave's or in my notes I have Arweave more tokens. More spelled MOAR.
I'm not even sure if that's worth going into. It's
Come
it
on.
did come to mind when
It's
you
funny.
mentioned the ICOs, or like the ICOs were in 2017. I don't think ICOs ever went away. The ICOs of like, here's a white paper, give me money. It turned into the NFTs. Here's a roadmap, give me money, which was exactly the same thing. And now what we're seeing is different experiments of fair launches, let's say, up to a point. But that, like, even the new token doesn't even apply with that.
But
I mean, I do think that.
Let's give some context first on the Arweave thing, so people know what we're talking about.
Okay, we mentioned a bit that there's Arweave. We've gone over it, the permanent storage platform. We mentioned a few calls ago that they were launching a separate token for AO, their distributed compute layer, let's say. At the time, we rolled our eyes a little bit because another token, but I argued that at the very least, there it's somewhat justifiable because there is a completely new system that only happens to use Arweave for the storage of the messages that gets passed around. So this could be seen as something that leaves completely independent of Arweave. And by the way, getting back to the fair launch,
fair launched in air quotes to token holders, and so essentially maintains status quo in terms of whales.
It is. Well, it will be fair launch to token holders, yes. But the other side is that people get to lock STETH into a contract, and then they get a proportional amount of AU. And I was trying to figure.
Fair launch to both Arweave and Ethereum whales.
Yes, that's the thing, and that is where it gets closer to ICOs because it's really interesting. They did it with STETH specifically, and at the time you asked me why STETH and not another token, and I hadn't really looked into it, and then it dawned on me that it is because STETH is a rebasing token. So given that the contract is the one that's getting the contract is the one that's holding the STETH, then the contract is the one that gets the dividends from Ethereum. I'm just going to go ahead and call it dividends, the staking rewards. So when you withdraw the STETH that you deposited, but the AO organization, whatever it is called, ends up keeping the staking rewards and distributed across the ecosystem. So anyway, that's how they're doing that and why they're using STETH. The other token is that I just found out a few weeks back. This is from back in February. I just hadn't looked into it because I hadn't been looking at the ecosystem that much. I basically stumbled upon this r.io paper. where apparently they're launching a new separate token, an IO token that is to incentivize
So
the
to be clear, a
gateways.
third token,
A third token,
launching
and
two new tokens.
but the issue with this one is much closer to Arweave's original purpose, right? I suppose that the argument there is that the Arweave tokenomics are only for people to store the content and to keep the content around, and that the gateways are not incentivized. Therefore, we need a new token to incentivize the gateways. Frankly, it seems that like this could just be AO anyway, because I would argue that a content network without gateways is pretty useless for most people. But what are you gonna do? You get to launch a token, you launch a token.
Here you
So-
see that kind of Helium is also a good example of this, where they have multiple tokens, and you can think of it as like an augmentation of the cap table in a way, where let's say you locked in a certain token economics and distribution, and you can't change that or something like that. Like launching a new token effectively allows you to drive growth via new incentives and like change the kind of the ownership structure in a way that you want to, which is a kind of a response to the fact that everything in crypto has been based on like a BTC cap table in a way, where it's like it tapers off and then there's like some finite amount of them, but normal like cap tables don't work like that. You can always like issue new shares, right? And that way like grow something. So I think it's more about that actually in most cases than it is about like thinking of, hey, this system does that and this system does that, because you could just issue more and issue those based on like, okay, this system will get like this part, but you're not really able to agree on that. And like in a decentralized system, it can be hard to do or impossible to do. So then like what you have to do is like launch a new token, and then you can tie it to the old cap table in a way by, let's say 50% goes to the old cap table. So there's like an incentive there, but then effectively they get diluted if they're like overlapping business model. Like it's much more a question about those kinds of things than it is actually about like anything else, in my opinion, in most cases.
Yeah, well, the other thing is kind of like the other analogy that came to mind is the maker end game strategy. And so like one way to view this is also like maybe like each sort of modular piece in these large systems should have its own token. Like it has a different revenue profile, different people, different investors, different returns.
When should a startup spin out of an existing company? It's like kind of a question.
I buy the maker endgame submodule argument for AO. That's what I mentioned, that it's a completely different system. It's its own thing. I don't buy that it's Arweave gateways are a submodule, because they're not independent at all, unless the point is that at some point they're going to be gateways for a PFS as well, or who knows.
So the like these are, I think, like mine and Mika's interpretations as far like the not cynical ones. The cynical interpretation is that the token is sort of fairly flat, and actually it's easier to get a additional token to, let's say, a 500 million valuation than it is to grow the original token by 500 million. And so I mean, we're coming back to like the whole ICO thing. There are very reasonable, like there are reasons you might want to do this which are completely legit, but the concern, as with ICOs, is always like, are people doing it just because they can kind of hoodwink people into buying a new token and thus enrich themselves? So that's like, there's this balancing act which is tricky.
In the long term, though, that doesn't matter. What matters is like how much money do businesses make, and like in the end, like the market. We're talking about like the intermediate, and eventually, like the market sorts it out, right? Where okay, well, it's the same thing as, oh yeah, we will launch an L2 because there's a valuation premium. You just run that enough times, and there is no valuation premium. So it's kind of the same thing where you run this enough times, like by definition the market cap of all crypto can't go to infinite, so like it tapers off from there. There is certainly an advantage in like moving early to kind of these things in a way, but that's separable from like kind of the end goal of everything and what it looks like at the end.
Yeah, but I think yes, that is true, but I think also the market the market stays irrational for very long periods of time. Like if you look at Stellar, which hasn't been relevant for God knows how long, it's still trading at like, I don't know, it's billions. And so if the dynamic is that like the market will not price you properly for potentially 10 years, then the incentive, like, and specifically if you think the market will price you like way higher than it should for 10 years, then the incentive is to just do this as many times as possible in the shortest amount of time, and that is actually the rational way to increase your or maximize your upside. And like with ICOs, like that's not necessarily a good dynamic. There's not much you can do about it because the market is doing what it's doing. But yeah, I think so to just
That's
like
true. That's
sum up,
true.
I think like I used to think the market is very optimal for doing all things. I've since come to the conclusion that the market actually consists of a lot of people that like just sit on their stuff, they don't pay attention, and so they're not actually acting rationally, and the market is like a combination of people trying to manipulate the market, people not doing anything, people FOMOing in because they heard it from a taxi driver somewhere, etc. And so the market pricing is correct in terms of the market, but is not actually necessarily a reasonable thing. And that's why I do criticize people for abusing that is maybe what I'm getting at. And it smells a little bit like Arweave is. And that's
totally reasonable, I think. Yeah.
By the way, as we can perhaps circle back to your initial question of are we in a bull market or not, because the fact that these things are gaining some traction, to me, does indicate that we might be in a lull in the bull market because we're not up only, but it's still bull market behavior that people are willing to say, look, when I last checked, it was like $600 million worth of ETH, at like 190,000 ETH or something, 180,000 ST ETH were locked on this Arweave thing. That is a non-insignificant amount of money for people to lock for another token that might not be issued until February.
But
yeah,
that's
that's
an internal
trade where you're making my lost yield is smaller than the airdrop size.
Sure, but my point is that this is still behavior where people are betting that they are going to get more value out of the AO token in February that they would get out of being able to liquidate the extra ETH yield next week. Right? That is closer to a bull market bet.
Internal crypto people are betting that the bull market will continue or start or whatever. What I was saying regarding the bull market is I don't think we've seen any like actual bull market behavior, which is sort of like external people coming in. So like we're playing musical chairs inside the industry, but where what defines an actual bull market is an influx of new outside money, and that I don't think has happened outside of the ETFs.
I think that to answer that categorically, what we actually need to do is look at the money flows into stupid meme coins and celebrity coins on Solana. Because again, I'm pretty sure that is money that otherwise would have been going into Stellar and that shit because of the unit cost bias.
But the total market cap is still quite low relative to like 2021 high. That's the metric that is like
and new money from outside sort of the existing crypto users is not flowing to meme coins on Solana because they don't know how to find them. New money that flows into the market comes through Coinbase and goes into the top things or like whatever, like first it hits like the things that Coinbase lists, you know, and is very indiscriminate historically, at least. So this isn't a negative view, by the way. This is like a potentially shit is just getting started view. On the flip side, like the other way to interpret this is like crypto is playing musical chairs because we think a bull market is going to start, but maybe people don't have money because interest rates are high and it never will. Like that's the negative.
Yeah, the market structure maybe has changed. I hate to say forever into the positive, but in a way you could argue that the ETFs are a mechanism which allows someone to discriminate between the assets easily. And the fact that those will be limited to BTC, ETH, Sol is going to be next. And then eventually, and you already see this with like the Bitwise or some other like these indexes, which you can argue about if they're intelligently constructed or not, but they're trying to be at least relatively intelligently constructed. So that means that maybe the follow goes through those kinds of instruments, and then the quote unquote fundamentals actually matter. And then you never ever get a situation where it's completely indiscriminate unless it's like a weird bubble, but you can get like quite far in the growth cycle with like more intelligence in terms of allocation. That's a positive way to explain it. That may not be true.
The negative spin on that is we're back to traditional finance gatekeepers, if that's the way it goes.
No, but you can still have an index that's like on chain and permissionless with like people who make those indexes being distributed and yada yada. Like you can get better versions of that.
I'm just saying
while all of that is possible.
Wait. If the new money flows come through the financial instruments that are trading on traditional exchanges, then we have the same gatekeeping that we've had in the traditional financial system. And it's not because you can't access the other assets, it's simply because like the friction of accessing them compared to just using whatever your stock brokerage is too high. I'm not saying that's necessarily a bad thing. That may in fact be slightly better, maybe. But it is sort of bound to happen in some ways. Like right now is like the SEC decides what pops, sort of thing, right? Like
yeah,
and the Ethereum ETF or Ethereum is traded down since the ETF, but. You know.
And there is a real chance that the sixth ETF is a Litecoin ETF. So there's not like a 1-to-1 match between quality and what these people decide to do on like the service level. But it is you can argue that you are moving in somewhat of a right direction with like just more intelligent asset selection within indices, and then what platforms those live on and whether they live directly on chain and how like decentralized or gatekeeped they are, like that you can slowly start to move in the right direction from that.
Well, I've made the prediction that I think XRP ETF is going to be coming soon.
Actually, your prediction was that it was going to be the next one.
Yeah, it may well be. It may well be, and my prediction rests exclusively on the fact that Ripple has a lot of money and they definitely understand that this is what they need to be doing, and they've traditionally been very good at sorting things like that out.
Yep.
Like
on the other hand, one of the
endless amounts of money to get this ETF done.
I agree with that, but on the other hand, one of my main objections to like people jumping on the Solana's got to be the next ETF thing was the fact that unlike Bitcoin and Ethereum, Solana had been named by the SEC as an unregistered security in Coinbase complaint, against Coinbase and Binance. But I saw a few days ago on news item that apparently the SEC has decided to not pursue under complaint against Binance, having to demonstrate that Solana was an unregistered security. So maybe that gives it a leg up in there.
Yeah, these are always have to be careful, like the law stuff. But if Ethereum works a certain way, POS chains work the same way as well. Like in like the fullness of time, at least. So,
yeah. I mean, a lot of it has to do with like the way it was launched, but I don't think there's a huge distinction between how Ethereum was launched and how everything else was launched. So
arguably early access in Ethereum was open and Solana was not. Anyone who could buy Bitcoin could send it to a certain address and get stuff. And yes, there were order sales and whatnot, but arguably the access was open. And in Solana, it was a regular venture round.
okay.
We're back at the ICO discussion at some point here, I guess.
Hey, actually, that is a good change of pace. We're touching back on topics instead of ending up in, I don't know, canoeing and rock climbing, which is what sometimes happens.
Okay, well, I think that's maybe enough for today. So thank you everyone for listening, all 50 million of you, and we'll see you next time.
Ta-ta.
Thank you.